So far, Nifty 50 has declined 15%, the Nifty Small Cap 100 has fallen 22%, and the Nifty Mid Cap 100 decreased by 19%. Even Nifty Next 50 also has fallen by sharp 24.5% from its highs. It is important to note that 2024 was the ninth year of positive returns in Indian markets. Now, this market correction has brought Nifty valuations closer to their 1 year forward PE average. Now, following the underperformance, the India premium has also adjusted and is now much closer to the average compared to other emerging markets. We definitely cannot control external factors like tariffs and their impact on countries, including India, and geopolitical uncertainty. But how can you now look at specific fund categories? And if we talk about a hybrid product in your portfolio, how can we look at aggressive hybrid category? Let's discuss. I have with me Mittul Kalawadia, fund manager, ICICI Pro MC. Hi, Mittul. Good evening and welcome to the show. Uh, Good time to look at aggressive hybrid category. What will be your take?
Yes, aggressive hybrid is a good strategy to look into for a volatile market,
Sure.
especially for investors who have longer investment horizons. So, any investor who's young or somewhere in your 20s, 30s, 40s, and you have a very long horizon with you for investments, this kind of a fund makes actually a very good sense for investors who understands the cycles of market can be volatile and they want to benefit out of it. So this is one product which actually fits that basket very well.
Talking about ICICI Pro equity and debt fund, I really wanted the composition and so far the exposures that you have in equity.
Sure. So in terms of exposures, banks we like power, we like automobiles and telecom. Along with that, we also like some retail stocks. Basically, we have a style where we look for sectors going through some downturn or sectors going through bad cycles or sectors going through some bad news. So bad news, bad cycles brings you good price. That good price helps you make money over a long period. So that's our style, and that's what we keep looking for over various point of time. Today we are seeing, apart from that, today the portfolio also consists of stocks where we have very high predictability of cash flows over the next 2 3 years, strong balance sheet. We had reduced our mid and small cap allocation over the last 12 months as the valuations went up. So we, as a prudent risk management strategy, we kept on reducing it, and we moved money to companies or stocks and sectors which are more having a strong balance sheet and good cash flows over the next 2 3 years.
Exposure
So
like
we thought that
so
we
so Mithul,
expect
what will
these.
be the sector exposure? So now since
Yes.
it sounds like you are more heavy on the large cap, is that right? What will be the sector
Yes.
allocation then?
So sectorally, if you look at the top overweight sectors are telecom, banking, then we have retail, we have power, we also have good automobiles as a sector, auto as a sector, and along with that, pharma. So these are the top sectors in terms of weight in the fund today.
All right, one last question and then we'll wind up this particular segment of ours. I just wanted to know now, if in a portfolio there is a pure large cap, mid cap, and small cap, how much of an exposure should be given to this kind of a fund? I mean, it's definitely a fund, where you can have stability in your portfolio. One can taper down an expectation in a mid cap or a small cap fund, maybe. But then, what amount of exposure should be given to an aggressive hybrid?
It actually it depends on person to person, so it's always prudent to do a proper asset allocation for yourself. But as I said, anybody who has a longer horizon, this fund can actually fits well for a very large allocation into the portfolio. Uh, Two reasons. One, it has a good mix between equity and debt, and we dynamically change this equity mix and the debt mix over a period of time with different market valuations at different point. Along with that, the fund strategy is such that we do diversifications into large cap, mid cap, small cap. We also change that also dynamically. So over a period of time, if you see in 2017, the fund had reduced the mid and small cap considerably, allowing it to increase the mid and small cap from 2018 to 20 when actually the mid and small caps did not do well. Similarly, in the last 1 year, we have reduced our allocations in the mid and small cap. At some point, when the valuation is correct and things are right, it will give us opportunity to build that segment of the market again. So that's something that dynamically we do it, allowing the investors to take a back seat and actually enjoy the benefit of this dynamic management in mid and small cap as well as in the debt and equity allocation. So it can form a good considerable part of the portfolio, somebody who has a longer horizon.
All right. Thank you so much, Mittul, for being there on the show today and talking about the fun nitty-gritties also. Thank you.
Thank you
Time
very
for a
much.
quick break, and post that, let's get connected with Gautam Kalia. We'll be answering your portfolio queries, and just in case you want to send across your questions, you can do that on a WhatsApp number and email ID.